Right, well, here with his advice on the best investment opportunities as we move into the third quarter is Richard Lacaille, Global Chief Investment Officer at State Street Global Advisors. He oversees around $1.8 trillion in assets. Thanks so much for coming in to speak to us. So, if you could just put this into some perspective for us, I want to start by asking you about earnings season so far in Europe and the US. There is a great deal to consider, but what does it tell us so far about where the markets are headed as we go into the second half of the year?
Well, you're at the tail end of that process where productivity growth has been high. Earnings have been better than expected, both in the US and Europe. US a little bit ahead of Europe in terms of expectations. We think there will be a bit of a slowdown. Clearly, that's in the macro data. We haven't yet seen it in the micro data. So it's interesting that the micro picture is much more optimistic. And I think if you look at some of those core European companies and companies in the US, the sort of messages they've been sending out have been pretty positive. But the macro picture's definitely been a little bit more sobering for the rest of the year.
And in terms of investments, you're favouring emerging markets right now?
We're still favouring equities and we're still favouring risk with a little bit of a tilt towards emerging markets. We have been overweight in emerging markets. And again, part of an overall risk trade where we're underweight in really the safe havens.
The safe havens, and you are underweight on bigger developed markets?
Well, we've got a balanced portfolio, yeah, a little bit underweight the largest developed markets, a little bit underweight in cash and the least risky assets, in favour of those value opportunities that we're seeing both in equities and in credit to some extent.
So, are you positioning your portfolio with inflation or deflation in mind?
Neither. I think there's clearly no sign of inflation. Productivity growth, again, is petering out in the United States, but you certainly wouldn't say we're near to a capacity limit. And again, the same is true in Europe. But bond markets are pricing in very aggressively a low inflation period for a very long time. And it doesn't seem to be that there's anything to be made by betting in a large way either for or against inflation. So this is a risk trade based on growth in the economy, and it doesn't have to be very vibrant growth in order for this to pay off.
Now, markets have been in a tug-of-war recently, some would say, between companies reporting great earnings and worrying signs about the economy, with some mixed, if not disappointing, economic data. Which will win out?
Well, I think investors haven't yet flipped to a completely macro view of the world. There were obviously periods in 2008, 2009, where the bottom-up story became pretty irrelevant. People focus on that top-down picture. I think although people are expecting a slowdown, and that will translate into earnings, they expect that to be a slowing rather than outright double-dip recession. That's currently priced. Now, if signs got significantly worse, particularly in the employment picture in the United States, that could change.
So, Richard, where else do you see the best investment opportunities right now?
Well, I think equities still offer very good value. The question is what's going to unleash that value from a catalyst perspective, because mutual funds flows have been very weak with the exception of emerging markets. M&A activity is much more subdued than it would normally be at this time of the cycle. And so it's hard to see what would be the catalyst. But riskier assets, I think are things that one would want to avoid. Certainly levered private equity, because that will not pay off until you've got the backlog dealt with.